think when you see the trading revenue, it offset a lot of the credit reserves that you saw for JP Morgan, Citi, and Wells Fargo. But I think this was a kitchen sink quarter for the banks in the sense that because of the CECL accounting requirements, they had to effectively take 100% of their expected credit losses for this crisis all at once. So I think the worst is behind us. You had the CFO of Wells Fargo on CNBC in the United States at 3 o'clock yesterday, and he basically said it's highly likely that 100% of the provisions they have to take have already been taken. And it's interesting also about Wells Fargo, they cut their dividend 85%. That's going to save them about $6.7 billion of capital every year. It's rumored they're going to cut about 10,000 jobs to save another $10 billion. The last time they cut the dividend of this magnitude was March 6th of 2009. And that was when all the bad news was in. In the next 2 months, the stock appreciated over 250% off of those lows. So I'm not saying that's necessarily going to happen this time. I am saying that a lot of the bad news is out now. All the expectations have been lowered, and they've set themselves up with all the provisioning on a go-forward basis to surprise to the upside in a major, major way as we come out of this crisis.
Thomas, I want to bring up Jamie Dimon's comments because I thought his remarks were quite interesting about just how murky the outlook is still. That is not a typical recession. And if you think about what we know, there's been furlough schemes, government assistance, and particularly in the states, that top-up payment if you are unemployed, $600 extra, that's made quite a difference where you don't necessarily go into default on some of your mortgages or loans because it's an additional income booster. This could all change, though, in coming months because we don't know if it's going to be extended. So what does that mean as we step away from the traditional stress testing models and we take a look at some of the extra stimulus that's been applied in this crisis?
Yeah, well, I think for certain what we're seeing is Secretary Mnuchin is talking to Congress. The Republican Senate is talking to get a deal done. And it looks very, very likely that they're going to get at least another $1 trillion passed. But you have to keep in mind, because of the CECL accounting rule, they had to take 100% of provisions in this quarter of what would be a very bad or worst case scenario. So if you get the stimulus, that's much better than expected. And again, they're going to be over reserved and beat to the upside. So the worst is baked in. It's very likely that we're going to get additional stimulus. We're going to get stimulus payments directly to the most needed. And we have close to $10 trillion of stimulus liquidity and aid already authorized, much of which we haven't even started to use yet, and the Fed backstop, which is committed to doing at least $80 billion of mortgage-backed securities and Treasury securities for the foreseeable future until they bring unemployment, till they get back to full employment in the mid-single digits, which we've already regained about a third of the jobs that we've lost, and until they hit inflation on a symmetric basis. So their inflation target is 2%. That means the Fed has to stick in there with that backstop until they're consistently well above 2% for many months in order to hit that symmetric target. So really the table is set, expectations are low, just like we're seeing in the global economic data with the economic surprise indices. The data continues to beat to the upside, and I think these banks, trading for some of them at a discount to book, are really set up as opportunities moving forward.
Thomas, let's widen the conversation out to not just banks, but other cyclical parts of the market, energy. Over the last couple of days, we've seen this emerging demand for these underperforming parts of the market, the parts of the market that have lagged, the big tech companies that have led the gains since the March lows. Do you think this trade has legs? Are we going to see from here more money put to work in these less loved parts of the market?
Yeah, I think you hit the nail on the head there. And historically, what we find is that cyclicals outperform coming out of recessions because the growth bar is so low, and cyclicals do best in high economic growth environments. What you've been seeing is this epic battle between growth and between value, between cyclicals and between tech. And the reason is as you saw in May, when our cases were coming down dramatically and coming down quickly, everyone was pricing in a V-shaped recovery, and cyclicals had an amazing month and value had an amazing month. Then we had a short-term spike in the Sun Belt, and in the last few weeks, you saw tech start to outperform. But the good news is that looks to be in the rearview mirror. The 5 worst states, California, Arizona, Texas, Florida, and Georgia, although it's reported all the terrible cases, they've actually peaked every single one of them, either within the last 24 hours and have come down, but in most cases, it's been multiple days, if not a week, since they had their spike in cases. That's number one. And number two, we had a data point from the Bank of America Global Fund Manager Survey this month come out yesterday. Only 14% are expecting a V-shaped recovery. So there's still a lot of pessimism amongst managers managing 500 billion of assets, 200 were surveyed, that this will happen. So we have a wall of worry in sentiment that this market can continue to climb moving forward. So a lot of things are pointing in the right direction, but the number one thing for the V-shaped recovery, V equals vaccine, and we got great news on that with Moderna last night. Great news on that from Pfizer last week, and obviously the Oxford vaccine is a front runner as well. So a lot of things lining up for the right direction.
But Thomas, on that point, in terms of what the market is pricing in with regards to a vaccine, interesting to see that we've had a rally on the back of both pieces of good news out this week, BioNTech and Pfizer getting that FDA fast-track designation, and then Moderna last night. Does this suggest that markets are not pricing in that we do get a vaccine in early 2021?
Yeah, I think the market was a little bit skeptical in terms of until you see the data, it's very hard to believe. You know, we've had many false starts with treatments that were expected to be very good, and they've proven to be just okay. The treatments are getting better than expected, but the idea of actually having the vaccine before the end of the year, in the case of the Pfizer vaccine, to be fast-tracked by the end of October. Production of these vaccines is already happening. So, you know, as we're in mid-July now, it's only a few months away until something is approved. The production is happening at risk in the background to these companies, and we'll be in very, very good shape. You know, the market, the S&P 500 in the United States, hit about 3,400 on $163 of earnings in 2019. The estimates for 2021 are still up over $163 a share.
Thomas,
so there's no
reason
that we can't get up to those levels.
Thomas Hayes, thank you very much from Green Hill Capital.